Now, one of the most popular form of financial investment is stocks, and because of that, many people would like to go into stocks or are into stocks, for which the thought and techniques being needed to a successful stock investment is not there. And so this video is going to give us a lot about investment in stocks. Basically, we're going to look at tips, thought, and say techniques in investing in stocks. And so we are going to do some reasons here. Okay, the first one is that in the investment world, stocks or stock is the same as equity. It's also the same as share, as you get shares. These three words or terminologies are the same in the field of investment. Okay, stock is the same as equity, is the same as shares. It means that stock is equal to equity. Stock is the same as shares, and then equity is the same as shares. Okay, so wherever you are, or whatever you are doing with respect to investment, anytime you come across any of these words, they are same. So there's no need for you to panic. And then you also have a holder, a stock holder. So let's say a holder who in some similar terminology you can say have or have a. Okay, have a, yeah. You see that somebody is holding something, somebody is having something. That is the essence of stock holder. Or shareholder, or equity holder. Equity holder, yeah, this is respect to that one. So a stockholder is someone who has some part of control, some part of shares in the public company. Okay, the stockholder is someone who has a share. And so, if you have a share in a company, it means that you have a shareholder or a stockholder on them. Now, the third point is that, or thought for you to understand, is that in grammar or in English, you have something called share. Okay, share simply means that a fraction of something. Fraction, part. You also say segment. You can also say bit. Then you can also say a piece of something. And then you can also say portion. Further understanding of what a share is. A share simply means that fraction, part, segment, bit, piece, or portion of something. The third point is that in the field of general English or grammar, a share is the same as a fraction of something. Fraction, part, bit, segment, portion, piece, okay, and the synonyms. So whenever you hear a share, it means that somebody has something or a part of a bigger portion. That is what it means by a share. And so a share means that you have an ownership right in a company, in a public company. That's what it means in a share. So for instance, say a company has 1,500 outstanding shares, total shares, okay? Total shares. And then say Maria buys 150 shares, which represent, this one represents 100%, okay, which represent 16.7% ownership, okay, and then say Melinda also buys say 820 shares, which also represent 54.7% of the total ownership. Now, the total is 1,500, and so you can see that the remainder of shares will be 430. Now, the total is 1,500, and so you can see that the remainder of shares will be 430. Now, in the field of investment, you have something called majority shareholder and those kinds of things. You can see that the total is 1,500, and then Melinda buys 820 shares, representing 54.7% of this one. Okay. In essence, it means that Melinda is the majority shareholder with respect to this investment. Okay, and so the remainder can also be bought by some people, depending on the number that they are willing to buy. Now, the fourth point is that in the stocks are traded. Stocks are traded. Traded on the stock market. You have the stock market where you can buy and sell stocks. And so if you want to invest in stocks, you can invest in stocks from your house or from your room. You have to go onto the stock market. Then you can go and buy stocks from there. You can go and invest in stocks from there. One thing is also that every country has an institution that controls the stocks with respect to that country. And so wherever you are, you can invest in your country's stocks. Notwithstanding, you can also trans-invest in other countries' stocks with the help of computer and internet. You can do that at anywhere in the world. And so every country has a stock market. Then an institution that controls the stock market. Now, the stock market is the same or similar to the traditional market, where we sell and buy anything at all. So the stock market is specifically for stocks, for trading stocks, buying stocks, and then selling stocks. Okay. Now, a stock market is a marketplace where securities of publicly held companies, such as stock, bonds, and the likes, are traded. And so when you go into the stock market, you get stocks, you get bonds, you get other financial investment products. Now, we also have number 5 being the stockbroker. Okay. Yeah. A stockbroker is an institution or a person that works on behalf of other clients or business partners. Those people that want to invest in stocks, but they don't understand or they know the technologies involved. They will hire a stockbroker for the stockbroker to work on their behalf. That is the stockbroker. Okay. And so a stockbroker is always paid on commission with respect to the job that he does. And then let's do the number 6, which says that, let me explain this better. Public held companies. Okay. You can invest in stocks in companies that are public. Public means that they are not private. Public means that everybody around a particular location can go into the company and buy stocks. It's not for the one who started the business alone or who started the company or the entity. Now, the publicly held companies also means that publicly traded company. It also means that publicly listed company. It also means that public limited company. Now, a publicly held company is an corporation whose stock is sold in part or whole to and owned by the public instead of privately invested, and as such trade their stocks on the public exchange market. An interested investor can go into the stock market and invest in a public company. That's what it means by public company. And so when you want to invest in stock, as I said, you don't into the stock market, then you do your investment there. Okay, so the next point that I would like to talk about is the point 7, which says that the total value or market capitalization of all publicly traded stocks in the world as of the year 2020, okay, is 93 trillion. As of the year 2020, the total market value or the total market capitalization of publicly held stocks around the world is 93 trillion US dollars, which means that there are a lot of money in stocks. And then, as it has been one of the engines of financial growth for creating wealth by most people. So you can also go onto the stock market and invest in stocks, and it will help you a lot. Okay, so let's look at the other point, which says that yes, you have buying and selling of stocks. Okay, buyers bid, use the bid price, and then sellers go with the ask price. Okay, if a company has a total of, say, 200 total shares or stocks, and then it has been bought already, it means that you can't go and invest in it unless the one or those who are holding their stocks, some of them want to sell their stocks to retrieve or get some money. That way you can also go inside and buy some stocks. And so you, the one who is going to buy, you have to prepare yourself, go with a price, and that is what we call the bid price. That is the buy price or bid price. And then you also have the sellers, the one who holds the stocks and want to sell, becomes the ask price. And so you have three types of prices with respect to investment in stocks: bid price and then ask price. Then there's something that I would like to talk about here. I call it fluctuation. Yes. Fluctuate. In everyday language, we can say that order. You can also say that swing or oscillate. Okay, they are all synonymous to the word fluctuate or fluctuation. It means that the prices of stock on the stock market don't stay at one place. They go up and down, high and then low. Say it could be say $20 yesterday, and then in the next few minutes or hours it will be 25 USD. That's the fluctuations. So it goes up and down. Okay, so stock prices do not stay at one place. They are not static. They fluctuate or they oscillate or they swing up and down. That is why we can make money in stocks. We can also lose money in stocks, depending on when you want to sell. If you want to sell when the prices are high, it means that you are going to get money. If you sell when the prices are low, it means you are going to lose money. That is the essence of fluctuation with respect to stock prices on the stock market. Okay, so the number 10 point that we are going to look at is dividend. In the field of investment, you always come across dividend. Dividend is the sum of money that you will be paid for, or you pay to respect to your investment. The profit that you are going to get out of your investment in a particular investment vehicle or investment product. So in most cases, investment companies pay dividends every 3 months. So within a year, you are going to get, say, 4 dividends. So if, say, you are going to be paid with 12% interest rate on your investment, then it means that every month you get 3, and then 3, so that you can use the investment for whatever you want to use it for. Now, one thing about dividend is that if it's being paid to you, there are two things that you can do with respect to that. You can withdraw your investment, or you can withdraw your investment, then you can reinvest your dividend. So when the dividends is being paid to you, these are the two things that an investor can do to the dividend. You can withdraw and use it, or you can withdraw and invest it in another investment vehicle, and then you can also allow the dividend to accumulate and sum up with a principal, enlarging the size of the principal, for which you can also get returns on it. And so this is what you can do with investment. The best is that allow the dividend to grow with the investment. And then you can also, the 11th point is that you have to always look at a way that you will not withdraw your investment, that you allow your investment to reinvest, your dividend to reinvest with the investment. Okay. Now, when that happens, it means that your principal will grow, and your subsequent dividends or profit will also grow. Making you earn more from your investment. Now, the 12th point is that whenever you are investing in any company, it means that you are going to put your money in that company. So if you are working with a company, it is advisable not to invest in that company. When you do, it means that two things are involved, as somebody will say, your investment and you yourself making two. What will happen if the company goes bankrupt? What will happen if an emergency situation happens to the company? It means that you are going to lose your employment status, you are going to be fired, and you are also going to lose your principal, your investment money. And so it is very important not to invest in the same company that you are working in. Okay. It also comes with the mindset of diversification. If you are working in company A who invest in company B, in that instance, you are safe and secure. Now let's look at the 13th article of whatever we are doing this time around. Okay. Investing in stocks also involves risk. Yes. Involving in stocks also comes with risk. I've said that every form of investment comes with risk. Now there are two elements or two situations where risk comes around with respect to investment. Now, you can lose your principal. Okay? You can also lose your dividend. These are the two situations that can happen to any investor in the field of stocks. You can lose your principal, that's the money that you invested, or you can lose part, okay, and then you can also lose your dividend. These are the things that you wish it. Then the 15th point is that if you buy a stock, say the 14th point, if the stock prices fall, it means that your price or your degree of growth will also reduce. And so say somebody buys a stock at $15 per stock, and then the company that you bought the stocks inside performs poorly on the market, and so its value decreases, and then it affects the stock. It means that we are going to get around, say, $12 for the value of the stock, which is a reduction from 15 to 12. And so when you invest in a stock, these are some of the things that can happen. you can lose money. And then if this happens, it affects the quantity of your stock investment. Now let me say that the 15 point, we've explained that 15. So the system comes with the stock market. I've already said that is the same as, or is similar to other markets around the world. Every market opens and closes. The stock market mostly runs from Monday to Friday, from 9:30 at times 8 to 4. Okay, and then in some areas like in Europe, they don't have breaks around 12 noon for stock market. But in areas like in Asia, particularly Japan, Korea, and those things, they have breaks for lunches. And then you can also get some stock market closing on holidays, public holidays, whilst others don't do that. And so, if you want to invest in stock, these are some of the things you need to appreciate. Now let's look at the 17 points and then see what we can do. Whenever you want to invest in stock, okay, make sure you do your research well and invest in a company that makes profit. That is where your investment is secure. That is where you can also get your dividend. If the company doesn't perform well, it means that you may lose your investment. And so don't just invest in bigger brands with poor performance. Invest in highly performing companies. And then the 18 points will come to the point that if you don't understand how an investment works, don't invest in it. If you don't understand how it works, don't invest in it, or you may be doing a time bomb. Yes. And then the 19th is also very popular in investment. It goes with the element of diversification. Yeah. Diversification means that spread out your investment. Okay, spread out your investment. Don't put all your money in one investment product. Try to open up. That will help you a lot. Let's look at the 20, which says that if you want to invest in stocks, mostly there are two types of stocks. Okay, two types of stocks. Yeah. You mostly have the common and then the preferred. Yeah. They all have their advantages and their disadvantages. So if you want to invest in stocks or shares or equity, you should be able to read on these things and understand them before you do that. But in most cases, if you want bigger returns, you go with the common. The common also comes with bigger risk. Okay, if you want safe investment, you go with the preferred stocks. That's what it means. So let's look at the 21 point. 21 point, it says that yes, investing in stocks doesn't give you not quick rich something. Okay, if you invest in stocks, you don't get rich quick, but then you get rich slowly. This is the difference that I want you to understand. Slow and then quick. If you invest in stock, you don't get rich quickly, but you get rich slowly. And then history or theory behind this is that for the past 100 years, the stock market has been the best form of creating wealth. And so if you want to invest in stocks, if you want to go into investment, the stock market is always the first choice because it has a steady growth over the last 100 years. So do well to also understand that. Let's look at the 22 point. Yes, emergency fund. It's always important to do that. Whenever you want to go into investment, try to understand what emergency fund is and then put it into practice. Don't just go into investment because you want to go into investment. No, don't do that. And then there is a rule that I would like you to understand, which is a 23. Yes, you call it the rule of 72. It deals with some people. Whenever they are going into investment, they are trying to understand how long it will take for their investment amount to double. Say if somebody invests 500 USD, how long will it take for the 500 to reach 1000? That's the rule of 72. So the rule of 72 will let you understand the number of years that your investment can double, and it's simply done by dividing 72 by the rate of interest. Okay, so if you have, say, 7%, it means that you're going to divide 72 by 7. Then the number that will give you, or if there is a point, it means that you can approximate it. It will tell you the number of years that your investment is going to take to double.